Welcome to the NFT Finance Podcast, sponsored by Goldman Sachs. My name is Terry, and I'm once again joined by my co-host Thomas. Today, we welcome Mary from Bridgesplit, a protocol that provides NFT collateralized loans.
Hi, Mary. Welcome on the show. Glad to have you. Let's jump right in. Would love to get to know you a little bit better. Can you tell us a little bit about your background?
Yeah, for sure. And thanks for having me. But yeah, like you mentioned, I'm one of the co-founders of Bridgesplit. My background kind of started in machine learning, have been always building things on the side, discovered crypto with my co-founder during kind of the big DeFi summer. And he and I have always kind of broadly been interested in finance and economics, and found this intersection of technology and finance to be super exciting, specifically this idea of kind of rebuilding a digital native financial system. And so we started Bridgesplit in late 2021 now, and with this goal of creating NFT infrastructure, NFT financialization infrastructure, and haven't really looked back since. So.
Awesome. So maybe what is Bridgesplit and how does it work?
Yeah, for sure. So Bridgesplit is an infrastructure protocol. And what I guess I would label as what's unique about Bridgesplit versus other NFT finance protocols is we don't really view ourselves as a new type of financial product tailored to work with NFTs, but rather the connective tissue between NFTs and traditional DeFi. And so some of that core functionality that Bridgesplit enables is the ability to fractionalize NFTs, pool NFTs, borrow against NFTs, and lending and these other financial products that the protocol enables are enabled by that fractionalization and pooling layer, which essentially lets you concentrate liquidity and create a fungible token, and solves kind of the liquidity and pricing problem that is kind of the underpinning of needing all of these very specific NFT finance solutions. And so the lending market itself is made up of a series of order books, so kind of similar to the peer-to-peer lending model, as well as automated pools based on collections or risk profile that algorithmically place orders on the order book to accomplish kind of some of the value propositions of something like Aave, where you can instantly lend and instantly borrow. And that kind of below that level of infrastructure is this idea of like vaults and engines, which we're really excited about, which is basically kind of this composable layer to program the way NFT value moves through the blockchain. I'm happy to dig into any of those pieces. I know I kind of ran through that quickly.
Yeah, that sounds like a lot of pieces. Would love to delve into more. I guess specifically, I believe a lot of our listeners will be very familiar with lending markets, especially P2P lending markets, as well as sort of, automated pools that bid on these NFT lending markets. That's kind of like a model that we've seen with Goldman Sachs ourselves and NFTFi and or Sodium Finance. I guess where I want to delve into deeper is fractionalization and pooled NFTs. Like, what does that mean and how do they work?
Yeah, for sure. So when we kind of got into the NFT finance space, one of the big things we noticed about the products that were out there was that the problem that they were really trying to solve with this specific solution was the fact that you couldn't guarantee a sale on an NFT. The floor price wasn't the true price. And so to us, that was kind of the core issue we wanted to fix was this liquidity issue. And we looked at parallels with like unique assets in traditional finance. And this is traditionally the model you see is this pooling of assets based on some either similar risk profile or similar characteristics to a buyer. And it's somewhat antithetical to NFTs because I think a lot of people, it's a non-fungible token. So how are you going to pool them? But we kind of ran some numbers and discovered that at least on Solana, 80% of trading happens at the floor. 80% of trades happen at the floor. And so to us, that presented an interesting opportunity to create a pool of floor NFTs and let people concentrate liquidity and aggregate buy and sell side liquidity in a pool versus only aggregating sell side demand in a way that you can't instantly sell something because there's no buyers. And so the mechanics of, we call them floor indexes or collection pools. The mechanics of them is they're basically made up of 1,000 fractions of a single NFT for a specific collection. And so I can go into kind of what it looks like to buy and sell from the pool, if that would be helpful, because I think that kind of clarifies some of the mechanics.
Yeah, that would be super helpful.
Yeah, so to buy an NFT from the pool, you'd be going to, say you have a Solana Monkey business, you'd be going to a Solana Monkey business pool. And when you sell or when you buy an NFT from the pool, you are swapping SOL. So this all happens in one transaction under the hood, but you are going to a SOL SMB index token, AMM. You're swapping your SOL for SMB index tokens, and then going to the pool and trading those SMB index tokens with a NFT specific fractional tokens that are in the pool. And then you are fusing those tokens to create the whole NFT. And so on the converse side of that, when you are selling into the pool, you are taking that NFT, you're fractionalizing it into 1,000 tokens via single asset vault, and then depositing those single asset tokens into the pool, and then receiving 1,000 SMB tokens back, and then using the AMM to instantly swap those for SOL, which sounds like it would be a nightmare for the user. But again, it's all an atomic transaction. Does that make sense? I'm happy to jump in there.
Yeah, that makes a lot of sense. And correct me if I'm wrong here, but it seems like a combination of two ideas that we've kind of played around with and seen before, which is the idea of fractionalize into multiple parts, and then the idea of an NFT AMM. So here, instead of having multiple floor items in one NFT AMM pool that other people can buy and sell out of, it would be fractionalizing one asset and then putting those into the NFT AMM. Is that sort of the correct way to understand it?
Exactly. Yeah. We think of it as kind of a cross between NFTX, if you're familiar, and fractional art, and kind of pulling out those best elements of capital efficiency and focusing on floor assets that like have high velocity of trading. So it's going to be capital efficient for an AMM, and then further kind of, I guess, increasing the supply of those assets by letting people sell any amount of their NFT into the pool. So you could actually theoretically sell 50% of your NFT into the pool, or buy 50% of an NFT from the pool.
That makes a lot of sense. How is the fractionalization?
It also helps.
Yeah, go on.
Sorry, I was going to say another benefit of the fractionalization, which like we didn't, I guess, consider until it was happening, was having the fractional pieces make it easier to maintain the peg on the, it's not a peg, it's backed by those tokens, but people can arbitrage a smaller token amount. So it kind of basically guarantees that the floor will most closely mirror the index tokens, versus if you're buying in these large quantities, and the arbitrage only makes sense if you're not going to be affected by the slippage.
Gotcha. As with fractionalization protocols, I believe like we've seen a lot of experiments in the past, and the issue has always been reconstitution, right? Whether it's fractional.art or Nibble. How is the fractionalization and reconstitution scheme? How does that work for Bridgesplit? And how is it different, I guess, from previous iterations?
Yeah, so we spent a lot of time working on this, and it's gone through a couple different versions, but the version that exists today is basically if you own at least 51% of the token, you can basically initiate an auction on the asset. And that is a 24-hour auction, and you have the ability to, just buy out the asset and using either your index tokens or bid via SOL. And to us, this was the most effective process because it didn't require, originally we had a voting schematic where like 51% of people could vote. But to us, we found that having as least friction as possible to be able to buy out the asset while still enabling some kind of challenge period, such that market incentives would ensure there would never be a buyout for some like very low price. And so that's ultimately the recombination mechanism we settled on. And so far, it's been working great. Like, obviously, in the early days of the app, we had to kind of keep an eye on auctions and be that market participant ourselves. But as the app has grown and we've had more users, that has become kind of a self-serving mechanic.
Got it. What is Elixir and Turnpool? These are sort of applications and extensions of Bridgesplit that we see on the website, but would love a better understanding of what exactly they are, how do they work, and what the relationship with the Bridgesplit protocol is.
Yeah, so when we first kind of jumped into NFTs, we were very excited, not just about creating this financial design space for the digital assets that exist today, but also for the market that we think NFTs are positioned to capture over the next 10 years. So our focus is really about being that infrastructure level protocol and seeing different applications like Elixir and like Turnpool building on top of the protocol in these very asset specific verticals. And so we kickstarted the Bridgesplit protocol with Elixir, which is one of the top marketplaces on Solana right now. And Elixir is focused on NFTs on Bridgesplit, or sorry, NFTs is digital art on Bridgesplit. And so on Elixir, it feels like you're trading with a marketplace like Magic Eden, but users are actually trading with pools of assets. And this infrastructure underneath creates a better trader experience via these instant sells and better prices. And you can also market make, and you have kind of this concentrated liquidity element. And so it's been a really awesome demonstration of being that connective tissue, because people are literally providing liquidity to Orca pools, but it's with NFT value. And then beyond Elixir, the applications of Bridgesplit and Turnpool come back to what are the applications of NFTs. And I think there's a lot of different axes you can evaluate the different types of NFTs or different types of assets that NFTs will represent. But one that I go back to is the spectrum of like digital native assets to off-chain assets. And that's kind of this dichotomy between Elixir and Turnpool. And so Turnpool, we've facilitated a couple of really cool off-chain private credit deals. So these are very institution focused. The NFTs are representing these basically loans to these large fintechs in the US. And the investors are exclusively accredited or institutional investors. And so that's kind of a whole different spectrum, but I think kind of demonstrates the power of this very general standard that it can kind of accomplish anything from a piece of art to a loan. And so we're now working with different customers that are building out their own investment platforms for these kind of esoteric asset classes, working on tokenizing like different types of internet native cash flows, and just different things like that, and creating these new asset classes. And so we've been working with them to use Bridgesplit to create these investable products out of these assets that they're bringing on chain.
Gotcha. That makes a lot of sense. So essentially, Elixir and Turnpool are like front ends that use front ends and protocols that use the Bridgesplit protocol that you guys have spun up in order, like as a go-to-market for the Bridgesplit protocol.
Exactly. The way I view applications on Bridgesplit is they're like a specialization in one asset class, and they focus on this, especially for these off-chain or pseudo off-chain assets, focus on this port of how do you actually represent this asset as an NFT on chain. And they're doing this go-to-market and creating this business around this marketplace of investors and borrowers or traders. And Bridgesplit is what enables them to kind of create that financial coordination layer between those two sides of the investment marketplace.
Gotcha. And I'm curious here, compared to other marketplaces and other, sort of higher level abstraction infrastructure that is similar to Elixir and Turnpool, how are they better because they use Bridgesplit as the base layer infrastructure?
Yeah, so the thing that I think has attracted our current customers to using the Bridgesplit protocol is it offers, kind of similar to what I was describing before, is it's not a finance solution tailored to NFTs, and it's more about making NFTs connected to the rest of finance and being able to make a real financial product out of them. So I think people view it as an option that helps them scale. So if you're doing like a peer-to-peer like lending protocol or peer-to-peer NFT lending protocol, that's not something that translates really well with financial markets we have today. You just like very rarely have like this one-to-one loan, and there's usually like this kind of layer above it with securitization and like syndicated loans. And so having both this pooling and indexing infrastructure alongside this lending order book, I think gives people a lot of options along the kind of spectrum of market maturity, where they can have this one-to-one option where people are just like lending against an asset. But at the point where they're scaling and they want people to be able to lend against a pool of assets, or if the asset does not have is not a large enough asset to attract institutional investors, they could pool those assets. And so I think the protocol is definitely something that can mature with a market, with the kind of nature of the indexes.
Awesome. What's the plan for Bridgesplit in the future?
Yeah, so we definitely Elixir is still something on our plate, but we've been, like I mentioned, spending a lot more time with customers working on different types of assets. So narrowing it down to Elixir real quick, the roadmap for Elixir is the public release of some of our lending and advanced market making products. Right now, those are gate kept to our NFT holders, and we just have been kind of running that through beta tests and making sure that's all good for a public release. So we're excited to launch that. So that'll let people provide liquidity to these NFT markets on a very granular basis. And it's much more capital efficient than the AMM structure we were using previously. And so there have been some funds and stuff that have been interested in that. And then for Bridgesplit, the roadmap is continuing to work with these different types of asset originators and refining the product to be kind of as easy to use as possible. Because some of the people we've been talking to are more Web 2 focused, might not necessarily have that much of a crypto background, or just looking to create investment products. So making sure we're abstracting the right pieces and continuing to refine the product on an infrastructure level. Because when we put it together for Elixir, it's kind of we were always just moving as fast as we can because the end customer was the user. So now kind of pulling out the bones of Elixir and making sure it's generalized and easy to use and composed with has been its own adventure.
Gotcha. Sure. Yeah, I want to pivot a little bit and hear more about your higher level views of the market. It seems from this conversation that you at least have a very different view of the future of NFTs and NFT finance, and specifically how the market will progress. My sense is that whereas other people believe, NFT finance penetration is going to increase as NFT markets, evolve. I feel like you have this particular thesis of, NFTs are going to denominate a lot of real world assets and real world value, as well as art assets. And the way to win in NFT finance is to go and capture those markets while onboarding directly onto NFT finance. I guess I'm kind of curious where the origin of that thesis is, and if I'm, misrepresenting your thesis, please let me know as well.
No, yeah, for sure. So yeah, I'm of the belief. So I think digital art has been is an awesome use case, and it makes a lot of sense as the first use case of NFTs because it's fully digital native. There's no legal recourse to the assets. People get paid out as they get transferred via royalties. But I think that within 10 years, digital art will encompass maybe 1% of all NFTs on chain. And this is largely just kind of boiled down to do you think everything will be tokenized or not? And to me, kind of the full vision of public blockchains is realizing this digital financial ecosystem and being able to represent all financial value on chain. And so I fully believe everything at some point will be tokenized. And I think something to acknowledge in that tokenization is most value in the world actually isn't very fungible. And we've created fungible tokens to help us transact that value, but things from and these are kind of the classic examples, mortgages and loans, businesses themselves. When you get equity in a company, you can think about it as a fractional NFT. That's a very unique company with a unique product, and you are getting ownership in it. And so I kind of view to me, I think we're at an interesting intersection in technology where we now have internet native money, which is kind of proliferated and is ubiquitous. But if you think about the internet economy, the internet economy has grown 7 times faster than the total US economy. Things like Stripe, things like Shopify have created all of these internet native cash flows that still haven't kind of been integrated with the rest of the financial system. So creators are getting paid out, but they can't really take out a loan using that value as collateral. And so I think that's kind of how this space is going to progress. Is I don't know that we'll necessarily see mortgages being ported on chain first, but rather these assets that are kind of the straddling internet native versus off-chain or real world assets, as some people like to call them. I think those will be those first things that you can kind of integrate at a smart contract level to create some software based recourse to those assets. And those things will start to become represented as NFTs, something like a creator, and a creator can sell kind of equity in their revenues or something like that over time. And so that's kind of the future I'm really excited about. And I think all of this stuff has a lot of room to evolve. And it makes, to me, perfect sense that it would happen on chain.
Awesome. As an endpoint, is there anything that you want to tell listeners about Bridgesplit and how they can participate in the future of Bridgesplit?
Yeah, I would love to talk to anyone generally that's working on any kind of investment product, and tokenizing anything on chain. I think we could probably help accelerate that a lot. But generally excited to talk to anyone about NFT finance or working in the real world asset space. I think I think a lot of people view this bear market as obviously a negative thing, but in some ways it's cleared out a lot of the noise in terms of you can't create this like fake value to create kind of this fake product market fit. And things that are sticking right now are things that are here because people find them useful. So anyone that's working on real world assets and kind of real forms of yield and cash flow assets, always interested to talk to them.
Awesome. Thank you for your time, Mary.
Sweet. Thank you both.
Follow me on Twitter. I'm 0xTayTayHoho on Twitter. That's Tay with an E. And you can follow Ryan at _Helmass.
Yeah, and that's _HELMASS. Thanks everyone for tuning in, and we'll catch you soon.